Good evening, everyone. Welcome to the FOMC. What is it? Is it FOMC meeting today? It is 20th of March, 2024. We are expecting the Fed to come in and say we are seeing that inflation is not coming down as fast as we are hoping for. So we are hoping for that they're going to acknowledge that maybe 2 or 3 rate cuts is appropriate for this year. And with me on that, I also have Joe with me, helping me making this, an understandable stream. Um, how are you, Joe?
I'm doing well. Can you hear me?
Yeah, I can. Depends if you can hear me though. That's the other
Oh, I
thing.
can. We're all good. No technical difficulties today.
Today, not sponsored, but hosted with some good stuff. What is it? It's Pepsi Max, I think it is. Not cool today, even though I should probably have had it for good reasons. I want to take charge of looking at financial juice to see if they have like a bot or something. And because it takes too long time to load this page and then run through it. Do you have any better ways, Joe?
Financial Juice Pro.
Yeah, I was talking with them for 1.5 years. I was supposed to get get in there, and then they never did anything. So maybe we should find an email from them because they were supposed to set me up, and they never set me up. So
Oh, that sucks.
that's on them.
They're very the people there. I've been following them for a while. They're very, very, very kind and reasonable. I'm sure it just kind of fell through the cracks, my men. They're very cool people.
Oh,
Um,
cracks. All right, okay.
Dude, they've been getting a lot of attention. So many people use Financial Juice now.
Yeah, I wish I did what I do, but I'm late to the party. But they never set me up on the party. Like they never set me up for success. So here I am losing valuable time. Anyways, should we say? So what is the expectations today?
Well, expectations for today are entirely focused on exactly what the dot plots come out as.
Mm-hmm.
So the consensus view is the median Fed dot plots, and the dot plots is a survey. So
Mm-hmm.
they conduct an anonymous survey at the Fed of everyone who's a member of the committee, and they ask, where do you think the Fed funds rate will be by the end of 2024?
Mm-hmm.
So when I say 75 basis points, what I'm really saying is the median of all the participants who think where the Fed funds rate is going to be by the end of the year,
Mm-hmm.
on median, expect it to be lower by 75 basis points from the current
Mm-hmm.
spot by the end of the year. Now, that's the nominal expectation. In fact, I'm seeing bonds, yield spreads move in favor of that.
Mm-hmm.
And some of the smartest commentators in finance have that expectation. So it's
Mm-hmm.
a very strong expectation. However, the minority that would be dovish, to be frank, by the way.
Okay.
That would be the dovish risk on expectation. The risk off expectation that does have some weight to it is instead of 75 basis points, essentially 3 25 basis point rate cuts sometime this year, that they only do 50 or 2 25 basis point rate cuts. Now, some people think that is plausible because of inflation being sticky. They see employment getting much worse. They see standards of living going lower, not just in the United States, but in a lot of other places. These are the same sorts of people that still think it's quite plausible that we have recessionary risks coming up here in the second quarter. So those people are in the camp of expecting 50 basis points and hawkish commentary out of Powell. The way I would generally interpret what the result's going to be is this. If the dot plots have an expectation of 75 basis points worth of cuts this year, that would be a risk-on move. And then we listen to what Powell has to say to what degree of bullishness we get. So a more neutral, hawkish tone with 75 basis points of cuts as the median dot plot expectation would mean we get only a little bit of risk on. If Powell doesn't really give us anything new, we'll probably be up at least 50 pips on something like Eurodollar. On the flip side, if we get 50 basis points as the median, and by the way, only 2 FOMC participants need to lower their expectation to 50 basis points for that to become the new median. So it's like razor thin margin there that you get 50. So if we get 50, that would put me in a risk off expectation. And then I would listen to Powell to see how risk off we end up getting by the end of the day, essentially. Then we have later down the road, we actually have Easter coming up here, and it's going to, I essentially think, whatever happens towards the end of this week for a lot of assets will end up being the start of momentum or a swing essentially into next week.
So, just a little bit of presentation. We have FOMC today. What is FOMC about? It is determining the direction of monetary policy. Okay, thank you very much. What is their job? Is to influence the availability of the cost of money and credit to help or promote national economic goals. In this case, inflation is too high. They're trying to bring it down. What did the triangle say to the circle? You have no point. How does it change? How does a change in federal funds rate affect the market? Short-term interest rates affects long-term interest rates, the amount of money and credit, and ultimately a range of economic variables, including employment output and price of goods and services. What are the key indicators that the Fed uses? Inflation, unemployment, GDP, housing spending, consumer sentiment, business sentiment, manufacturing PMI, services PMI, composite PMI, bond market, stock market, forex market, and the global market, and other economic development and other risks to economic development. How does the Fed implement monetary policy? Through lowering or increasing bond purchase and deposits. Now that we know what this thing is about, it is going to determine the monetary policy. What does that matter? Because that is going to increase or decrease the money supply, which is directly going to change the direction of the dollar and the market and so forth. So, as Plant of Profit says, it is FOMC in 20 seconds, and that one seems to be out.
Risk on, did we get 75 basis points as the median?
Interest rate projection for next year. Current 4.6, 3.1. So interest rate projection for the second year is lower than expected. I can probably show it to you. There. There. While I find.
Yep, 75 basis points worth of rate cuts. Now we wait for Powell to see how much more we get. Oh, I just got kicked out of my own account. So many people are logging in trying to trade right now. I mean, that's okay. I'm long the euro going into this.
Yeah, okay. Lol. So they are expecting for 2020, 2024, sorry. Most of them are around 475, give or take. Isn't that just 2 cuts?
High five, everybody. We did it. I think the interpretations were on point. The expectations were on point.
All right.
Now we just got to wait for Powell. No. Huh?
Okay. Fair enough. But yeah, first of all, they did not change their monetary policy rate. And they are, oopsie daisy. Their median view at the end of 24 is 4.6, which is the same as previous. And Fed projection shows that the policy view is unchanged at 75 basis points, which is turning euro higher. Can this market now reverse? Do you think, Joe?
I am not so sure, but I'm kind of looking at a lot of these weekly ranges. I mean, I was particularly in the last stream I did, I was looking at Aussie dollar on the pivots, and I'm like, ooh, this thing is not in a good spot. But I'm looking at euro dollar. This thing's at a good spot for finding a likely low on the week seasonally for this particular week. And when you're looking at seasonal data, it turns out that economic events typically occur during the same seasonal period. So if you look at the seasonal data for like this week, you end up having like a proxy for how a week usually performs, like relative to pivot points. And next week, I think the call for continued momentum in whatever direction we got this week is the way to go. So I'd say actually with a decent degree of certainty based off what I'm seeing, could be the low for the month. This could be the low for the rest of March at least, is my initial interpretation of what's happening right now.
All right, then if that's the low, then we are looking for dollar bearishness going forward. Then
yes. The yen might be a bit more difficult, the yen pairs, to be frank, because we can look at and talk more about the dollar pairs, absolutely, but this is now pretty straightforward. The dollar's probably going to get weaker from here into the end of the month. The yens are going to be a bit more tricky. Maybe you have some more commentary on that, because everyone has their own opinion on the timing of everyone. The consensus on yen seems to be we're going to get yen strengthening. It's just there's no consensus on when that's going to happen, if it's going to be next week or next 2 weeks or next month. So while we can look at these dollar pairs and say, yeah, dollar's going to get weaker, it's generally risk on, it might not be so easy on the yen side. We're playing yen chicken, where we're just we're two cars heading towards each other face on. The yen is driving one car and we're driving the other car, and we're just trying to ride out the yen for as long as possible before the thing turns off.
Before the engine before the engine goes in complete cool.
Exactly. Or before we crash into it. Yeah, that's what happens when you end up trying to short yen. You end up losing. Everyone loses in their game of chicken. It's a very interesting piece of game theory playing chicken with cards.
Because what is currently happening with the yen, with the dollar, is that it's currently falling, and as well, yen is also falling on the, or yen is not falling on it. The dollar falls, and then the commodities get stronger, which looks like yen pairs or yen gets weaker as well. But overall, there seems to be like a bit of confusion in the trading community why yen fell after the Bank of Japan meeting.
Oh, I have some good stuff on it. My
Mhm.
explanation might not be the most eloquent, but from
Is it
what
elegant?
eloquent, elegant. From the best of my recollection, it's about the size of the change. So they ended negative interest rate policy. They went to
Mhm.
from NERP to ZERP. ZERP is zero interest rate policy.
Mhm.
And the change from that was good. It's a very symbolic move, but the change wasn't that big of a deal. Like, traders want to get exposure to the change in things. And that change was actually kind of small.
Mhm.
What was a bigger deal that actually made the yen more dovish is they committed to, in the meeting minutes, to say, hey, if the yen starts disinflating again, we will just print more money. So instead of doing yield curve control, instead of trying to control the rates and keep them down for longer, they're just willing to print more money. And they kept it at that essentially. And they have a few different facilities of doing that. Plus, you have the MOF, the Ministry of Finance, that's eyeing dollar yen right now at these levels, saying, "Oh man, if you guys keep this up, we're going to intervene."
Like they get a kick out of it. Like let me show them what this is all about.
Yeah, it's another reason why trading yen pairs is like I compare it to a game of chicken, because you just do not know when the axe is going to come, when the kibosh comes. There is on euro dollar actually something quite important, I think, that's occurring this week.
Mhm.
Flash PMIs.
Yeah.
Flash PMIs. Every single time flash PMIs come out for Europe, it's a big deal, movement wise.
Mhm.
The last time we had flash PMIs, they came out to the upside. They surprised to the upside in France by quite a bit.
Mhm.
And man, uh, the euro performed quite well. And the expectations for this next round of flash PMIs, they're compiled by S&P Global, and S&P Global gives commentary on this stuff.
Mm.
The guys who compile this information going into these flash PMIs, say we have very good expectations that this is also going to be a good report. So euro might end up having kind of a double whammy here. So not only did it have the best yield appreciation in the G7 going into FOMC, not only did we just get a dovish risk on FOMC, but we could have another really good European flash PMI number come out. And the PMIs are used as features in many economic models for forecasting inflation, for forecasting GDP, for forecasting all sorts of economic indicators, because it's a very, very good survey of expectations. I mean, there's a
Mhm.
reason why some people pay 4 or 5 figures for the data from now S&P Global. It used to be IHS Market. it's very important to watch flash PMI metrics. Because if I can recall correctly, the flash numbers are reported when about 70% of the survey respondents
80.
80%, thank you. 80% of the survey respondents have filled out their survey. So the difference between the flash numbers and the headline PMI numbers usually isn't that huge of a deviation, considering they usually have hundreds of people in their survey. Sometimes that 20% does make a big difference because different times and different reports come out. You can have different variations of who's reporting what when. But the error seems to be fairly consistent between the flash and the headline number. So usually wherever the headline number is going directionally, that's typically where wherever the flash number is heading directionally, that's usually where the headline number is also going directionally. Might not be to the same magnitude. The last flash PMI, France did, gangbusters in the flash PMIs. But then when the headline PMIs came out for France, they were still in the same direction, but they weren't as big. So we could see a similar effect. It's on Thursday. It's coming out. So potential here for a double whammy on the European currency and European assets.
Mm-hmm. That's gonna send the euro dollar higher, potentially.
Yeah, if the commentary going into those PMIs from the guys who create the PMIs, S&P Global, is to be believed, it's likely expectations around it are positive.
Let me just have a rundown from Financial Juice here. So we're waiting for Powell to come out in 15 minutes or so. We are not right now talking about market turning risk on, because the median of the Fed is 3 rate cuts for 2024 at current level, additional 75 basis point for 25, which little change from the prior dot plot, but they have not gone more bullish, or they have not gone down to 2 rate cuts this year. And secondly, they have what I was saying. They have upgraded their GDP forecast from 1.4 to 2.1. And they see an employment rate at 4 versus 4.1, which is better than the December projections. And PCE at 2.4, which is an unchanged one, and core at 2.6 versus 2.4. So when GDP is pricing higher, Joe, is that a positive thing for the dollar, or is that a negative thing for the dollar?
I'm just trying to follow you. What was that last one?
They upgraded their GDP forecast from 1.4 to 2.1 for 2024.
The way the framework I would use to interpret that data would be the dollar smile. And in the dollar smile theory, the way you determine if that data is good or bad for the US dollar is you compare that GDP growth expectation, that growth forecast, with the growth forecast of the country you're trading the US dollar against. So euro dollar, for example, you're checking the GDP forecast for the same time period, for the same forecast horizon in the Eurozone. And then you're comparing which one has better growth expectations. And right now it does look like US has better growth expectations. So using dollar smile theory, that would mean that lends strength to the US dollar because all the economies are doing well, but United States is leading the pack. So that actually leads to some appreciation on the US dollar side of things.
So why would then why would dollar fall? But why would dollar then fall?
Well, that
they
is
are
a future forecast expectation for like the whole year, right? We're just at the beginning of the year. So these are quarterly forecasts. And right now we're moving in a direction that is more or less just dependent on like what the next week or two is going to do.
Okay. Yeah, I'm just putting it out there just for the fun of it, to be honest. Because I can explain I can answer my own question, but because you were quite adamant about that this is risk on. I know about the seasonality going in now to the end of March. I have previously mentioned that I am seeing euro dollar to go to, well, it's not like I'm seeing it, but I saw it, that I wanted to go back up to 110 maybe, or 111, more from a technical standpoint, that we tend to do that at some point during February, March, before then continuing, if we are supposed to be continuing a bearish overall trend. We haven't had that deep retracement as of yet. So that kind of, and the other side to this story is that we have already hit monthly target on euro. That would, I guess, less people are buying into the dollar than the euro, sorry, at the current level from a technical and money flow standpoint. But as you say, we now have confirmed, at least at this current point, that they're expecting 3 rate cuts. So rate cuts are still on the table, and in my unprofessional opinion, that is what they are kind of. That's what that's what the market is now celebrating. Just mentioning that the S&P 500 went up short for a short time for a new all-time high. We did a nice weekly setup here. I didn't take it, but I'm just acknowledging that's there. Does gold look good in your opinion for longs, Stefano? You have a very good question. I don't know how to answer it, because the funny part is I've not played this move, so I can't say I've been profitable in it. But I said somewhere, where has it been? Around February, probably. From earlier this year, I said to my friends that gold is probably going to go higher. So if you have anything, start paying attention at least. I think we're going to go higher on gold this year. We have, and this has been sparked by central banks buying themselves into gold, trying to play the deflationary play. At the moment, I would say gold, I'm not saying it's peaked. I'm not going to say anything about that. But I am, this kind of what we got as outcome today doesn't make, in my opinion, gold have more fuel to go lower. So as long as rate cuts are on the table, this one still has fuel to continue higher. Is that going to be today? Is that going to be tomorrow? Is it going to be in a month from now? I don't know. And on this live stream, I do not provide any financial advice whatsoever. It's totally up to you. It is just my, what's it called? My unprofessional opinion. So do your own research before you invest anything into anything. Do you have any thoughts about gold, Joe?
Yeah, I'd stay bullish on it. Going into the month, I've had a crazy month doing analysis on gold. I usually don't do analysis on gold, but in all seriousness, the pivots helped
Smashed.
a lot with the
This
pivots
one, you
helped a
mean?
lot. The probability pivot points.
Yeah. Okay. Fair enough.
Yeah, those specifically helped me figure out the first target for the month. So at the end of February, I set a target for essentially 2120, and we got there in the first 2 days.
Hmm.
And I was like, oh my God, this momentum is crazy. We were looking at CTA positioning, we were reading all the commentary, and like, oh my God, this thing's going to go higher. Where could this thing possibly go? Because at that point, there was no more data from the probability pivot points.
Hmm.
So I looked, and I actually used quarterly pivots. And the quarterly pivots then had put my eye on essentially 2200. And we went right to 2200. And I have drawings with timestamps saying, okay, next one is 2200. And the fact we got there in like 4 or 5 more days after that, I was like, oh man, this is really going to be nutty.
A bit of a crazy.
Yeah, but at that point, I started setting bearish expectations. At that point, it was a particularly good trade. And at the end of last week, so far my expectations have been met as to how this week was going to play out, with a bit of a drift lower in the first couple of days and then up into end of week. And right now we're getting that up, and hopefully this continues into not just the end of this week, but that momentum follows through into next week as well.
Um, 2.5 layers. Yeah. I lost my train of thought. Yeah, so I didn't catch anything on gold. And I can't claim anything there, but I'm glad you did. When we're going into now to the press conference in 6 minutes, what are you particularly looking for? What words or sentiment are you looking for Powell to slip into that might send us in either direction?
Yeah, this is the hard part. Doing interpretations of what Powell is saying and how that should, quote unquote, move markets is going to be subjective based off your level of experience. So if you're relatively new to this stuff, when you listen to Powell and you think to yourself, oh, that should be bearish, or oh, that should be bullish, and then you look at the chart, you need to take into account and be honest with yourself. If the thing starts moving up and you were bearish, your expectation on an interpretation of what Powell said was wrong. And then you need to find out why you were wrong. So then you can get better at setting expectations going forward. So you can get better at interpreting economic analysis, like from Powell or from anyone from any central bank. So it's a skill to learn what these guys are actually saying and the impact of what they're saying, the actual impact. And the easiest way to learn that, in my opinion, is to figure out how it changes current and future expectations. So does it change the what's called Fed reaction policy on inflation? Does Powell say something different about what his expectations are for inflation? Or is he neutral? From the consensus views that I've read on what to expect from Powell, people expect him to essentially just give token hawkish resistance. So nothing serious, nothing major, no hard commitments to staying hawkish, just being quote unquote data dependent, and that they are still optimistic about improvements in inflation and employment and in wages. Those are the three main measures that every central bank in the world right now is looking at: employment, wages, and inflation. They want to see all those things move in the right direction, even though that actually would mean harder and worse standards of living for a lot more people, frankly, for maybe like the next 6 months significantly before they start to rebound, which is, what a great economic system we have. Even if that's the case to quote unquote fix the economy, that does suck, but that is the policy that these people are looking for. So if that's the case, it is going to be this token resistance. That's the consensus expectation. And still being net optimistic about essentially the current Fed policy and token resistance for any future expectations of inflation accelerating. That's actually a big risk. PPI came out, remember, last week, towards the end of last week. It affected my trades because CPI came out good, and then PPI came out, and that surprised to the upside. What we do not want to see is a reacceleration in inflation, a massive reacceleration in wages, and a deceleration in unemployment. We want to actually see, for the central banks to be happy, unemployment to actually go up and wages to go down, and for inflation to go down. That's kind of the triple threat combo that we're looking for in order to avoid a recession. But for all intents and purposes, when unemployment goes up and up like that, the quality of life of people gets so unnerved. And it affects politics quite a bit. So you'll see a lot of people angry at the Fed, and a lot of people just mad at society and economics because of this policy, frankly. There's huge ramifications outside of trading to be aware of.
Yeah, also, yeah. If you don't understand, you're gonna be angry.
The more you learn about the world, the better at life you get. And usually I phrase that as, the more you learn about the world, the better at trading you get.
Yeah, that's probably a better way of looking at it. Now, as I believe people are in hardship, but I have never believed that violence has been the answer to or create social unrest, which does not help the economy. It does not help productivity and does not provide you with jobs. So I feel like it's very counterproductive, anyways. So we're just waiting for Jerome Powell to come out, and first he's gonna say what is on the statement, and then he's gonna have some questions, and then from there it can be a slippery slope into other bullishness or bearishness. If you have any trades on, I would say good luck. And from here on out, you're not on your own, but I will give commentary in between. I will probably end behind the actual stream when I pause and I give my 2 cents, but I will try my best to do that. So my expectations for Jerome Powell is that he I think it's going to be a bit more pessimistic and be like send dollar into to some strength, but
that is a real risk. It is a real
it's a real risk. Like, he can be so surprised and be like, or angry about it, that CPI did not come out as they ever projected in their slope, and it's now pausing a bit. Because he last time I think he said he would be surprised if inflation started reigniting again. So is this a reignition? I don't know. We're yet to see.
Here we go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong, and that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings, consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Good so far.
Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Use your brain.
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down, and so
when you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
So we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
Yen pairs are falling.
So
Back to
I think
Japan.
there's some confidence that
Squawk.
that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
And will you be able to get overall inflation down to target if housing doesn't break through quickly? And does that affect the timing for eventual cuts this year?
We will get
course.
aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, if we ease too much or too soon, we could see inflation come back. And if we ease too late, we could do unnecessary harm to employment and people's working lives. And so, we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
So I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more that we could, we wanted to be careful about that decision, and we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that you still need, or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions or about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
But, just a question of, is there even enough data for you to be able to?
We'll take, things can happen during an intermeeting period if you look back, unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Chris.
Hi, Chris Reaver, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about why might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question, I don't think we know that. I think we think that rates were generally low during the pre-pandemic post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. My instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero in some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already or you mentioned it being 2.8 in February. That doesn't sound like much disinflation at all. So are you still confident? Or the last press conference, you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, are you still optimistic that you'll get the confidence you need this year?
I think if you look at the SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year, and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment to Anne that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean, you saw last year very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Neil. Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now? And in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecasts?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying, we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now. And we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Go to Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, for independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate is for maximum employment and price stability and the other things that we do. And that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Claire.
Thank you. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than one dissent before you begin cutting rates? Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissents, and so you respect thoughtful dissents very much. It's like you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed, just to understand that book. So I treat dissents with real respect as well.
So Simon, one will be available.
Simon Rabinovich with The Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market, the extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects, the things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. You know, how tight is how easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You do see things like the low hiring rate, and people have made the argument that if layoffs were to increase, that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing essentially and we're not discussing many other balance sheet issues. We will discuss those in due course, but what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea. That's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system. And there can be times when in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress. And that can cause you to prematurely stop the process to avoid the stress. And then it would be very hard to restart, we think. So as something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's not urgent right now. We want to get this decision made first, and then we can, when the time is right, come back to the other issues.
Victoria.
Hi, Victoria Guida with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we and we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserve situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates. Those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops nearer at zero?
I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Let's go to Jean.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask also about the balance sheet. You said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up the process for deciding that sooner, or will you wait until we're close to the end?
So it's sort of ironic that by going slower, you can get farther. But that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Are they, right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these what's happening in money markets, in particular, a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point ultimately where you stop allowing the balance sheet to run off, but then from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks the reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand, and then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile, and we don't want to again find ourselves in a situation where there aren't reserves. We have to turn around and buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. We would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Brendan.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But folks, I know you have said to Congress that you are going to.
Someone didn't really do their job when they were thinking about what should this be about? What should our news be about? So it says punch bowl, but you say it as punchable. So
going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is.
We are not getting ready to. We haven't proposed. We haven't come to a conclusion that we should propose, or anything like that. That Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. It has applications in wholesale finance, in the payment system.
I just need to cut you short there. So if you say something that's going to screw up the entire market, then so be it. I don't have the energy for it anymore. And I'm 3 hours beyond food. So here we are. Dollar is weakening because number one, I said earlier that I said that they are still expecting, they can keep their rates higher for longer, but on the flip side, they are committed to to their rate cuts at some point. I'm just trying to find my own comment about it, but I can't seem to find it. Bank of Japan also came in with a bit of a headline in there. That was a funny one. That was funny. Funny as funny can get funny. So that was a Nikkei report, I think. Of course, it's not there anymore. I don't know if it took it away, whatever. But that they want to rate cut. They want to rate hike. Sorry, in like July or September or something. That was pretty funny because it makes the yen stronger when dollar's weak. But back to Powell. They have confirmed that they're going to see 3 rate cuts this year. so far. We need greater confidence inflation is moving sustainably lower before we cut rates. We are likely to cut some point this year. Traders are now pricing additional Fed easing in 2024. US rate remains unchanged at 5.5 as expected. And projections imply 75 basis point rate cuts in 2024 from a current level, additional 75 in 2025, and little change to the prior dot plot. Dollar and yen weakened. S&P has strengthened. I can see it made a new, brand new. Well, that was the wrong screen, right? Brand new higher high. So there is that. Yes, I'm referring to the Miser. I laughed when I saw it, but when I showed it on the screen, by the way. But yeah. Bank of Japan rate hikes in the spotlight as they are maybe thinking of July, October. Of course, why not? That's pretty fun. But I think the yen is still going to weaken beyond that. S&P, Nasdaq are all rising. There is Swiss National Bank tomorrow. That's gonna probably be bearish for the Swiss. But it's currently not catching a bid in that direction. I guess it's because all currencies, if I go through that for 2 seconds, all currencies against the dollar are strengthening. Swiss, British, New Zealand, Japanese, Australian, Canadian, and European, all of them are strengthening because the dollar is weakening. So maybe by tomorrow, we're gonna cut our market hasn't priced in a rate cut from the Swiss National Bank yet, but you never know what can happen with them. They have surprises before 2015. And what is 2015, you might ask, and why do I not believe them before I kind of see it? 2015, they dropped the floor and they said we're not gonna keep to our policy that we always have been. And then market fell about 2,000 pips, 2,200 in about split seconds, milli, micro, nano, those seconds, leading to substantial losses for people. Anywho. Yeah, I think that's probably it. I am going to update the mentorship group. So if you want to have mentorship call with me, for free and all that, you hit me up in the DMs. No strings attached. Just here to help you out. And of course, you join the Discord first, so you can kind of talk to me there. That's where I am. If I'm not on YouTube, which I'm not apparently lately. And yeah, so this is going to lead to dollar weakness. We have some dollar weakness in the seasonality. It's also, again, on euro, is by me expected to go back up to 110, 111. I don't know if that's going to happen. Can be news tomorrow or another day that's going to send this one downtown again. But so far, that's at least the direction that I see the market taking to 120, 110 before we figure out if we're going to go higher or lower. Again, S&P 500 going higher. Yet again, that is where the money is going. And yet again, it is pricing in everything now before the election year is starting. Any last sentence, Joe?
Not off the top of my head here.
Great. That sounds like a great sentence. Thank you for joining me, Joe. Thank you guys for showing up. Over 30 people of you. I love you very much. Hope to see you soon again. Maybe again tomorrow. We'll see. Boom. See ya.